at the outset, these are people who have dedicated a lot of hours over the past 5-ish years to CPA Ottawa, our little chapter here. First, Lisa Allen is the chair of our programs committee. She is a CPA. She works with CRA, Business Intelligence Group. She's been giving her time over, like I said, the past 5 years. The second person is Richard McNeil. He's the vice chair of our programs committee. He is also a CPA, also has been volunteering for the past 5-ish years. And he's the president of Otis Group, which is a financial management consulting firm. Lisa and Richard, could I get you to stand, please? Ted Cook is from the Department of Finance. He is here this evening. You know that he's here. That's a large part of why you are here. He wasn't the only person from the Department of Finance whom I called. He was just the only one who made the mistake of calling me back. Happens to be one of the highest ranking officials that I called as well, so that's nice. But in any event, by the time we got Ed nailed down, we had to get the word out quite quickly to all of you. And we had some assistance in doing that, and I wanted to mention those organizations and people. First off, the Ottawa Business Journal helped us publicize the event. The Ottawa Chamber of Commerce helped us publicize this event. Video Tax News, all the way from Alberta, provided us with some guidance and promotional support. And also Lisa Morrison, who's the tax law clerk at Haslow Law, she called over 200 accountants one at a time in order to get the word out. So thank you very much to all of those people and organizations. I want to recognize you in attendance tonight. We're very appreciative that the Ottawa accounting firms and financial planning firms are taking a leadership role in this debate on this issue, and in part of that leadership role, they're demonstrating that by buying a table tonight and showing up in full force. So Henry Warren, GGFL, Pro BGK, McKay Duff, Logan Katz, the Bookkeeping Bureau, Jack Bowerman Professional Corporation, Mark Payer and his colleagues, the Exponent Investment Management Inc., FEI Canada, and Scotiabank Wealth Management. I know that Welsh is also here. There's representatives from E&Y here. There's representatives from RCG as well. And a special thank you to all the solo practitioners who are here as well, who are engaging in this debate, who are making their voices heard. Thank you to all of you for being here this evening. We have a head table at our event tonight. The head table is sponsored by Haslow Law Business Lawyers, and I'd like to take a moment to introduce you to our head table guests. Our first guest is one of Canada's premier tax litigation lawyers. He spent part of his career as a senior official with the Department of Justice and has spent the last decade with Osler's, one of Canada's top legal firms. On numerous occasions, he's appeared before the Supreme Court of Canada to argue tax issues. Please join me in welcoming Ian McGregor. Our next guest is known for two things. The first thing he's known for is knowing a lot of people. The second thing he's known for is getting things done. He's one of Ottawa's 40 under 40. He's the founder and CEO of Haslow Law. Please welcome Hugues Boisvert. Our next guest spent almost 20 years on the bench of the Tax Court of Canada. I'm quite honored to say he's also a personal mentor of mine. Please welcome the Honorable Justice Cam McGregor. We've all heard some concern, and the minister himself acknowledged this, that the proposed changes may disproportionately affect women. Our next guest is an authority on women's entrepreneurship. Please welcome the president of the Ottawa Women's Business Network, Karen Wilson. I think you'll all appreciate what my next guest does as a side gig. When she's not teaching tax at the University of Ottawa, she runs a program in which she partners law students with self-represented appellants at the Tax Court of Canada, and those law students then go on to represent those appellants before the court. It's a very impressive program. Please welcome Professor Gabrielle St. Hilaire. Our next guest was appointed to the bench of the Tax Court of Canada by Pierre Elliott Trudeau. He went on to rise through the ranks and was eventually appointed the Chief Justice of the Tax Court of Canada. Please welcome the Honorable Gerald Ripp. If these proposed changes go through, they will require resilience on the part of accountants, financial planners, even tax lawyers. We will need to be resilient in order that our clients' businesses can be resilient, and in order that their retirement savings can be resilient. Our final guest knows a thing or two about resilience. He's a financial planner with Sun Life. He's also a 4-time world champion curler. Twice he went to the Brier with Glenn Howard as his teammate and returned with a gold medal. But a few years ago, at the age of 36, with a wife and 2 children at home, he started to notice some swelling in his lymph nodes. Swelling eventually moved up to his neck. Got some tests, got sent for some more tests. Eventually he was diagnosed with stage 3 cancer, Hodgkin's lymphoma. He had to walk away from the sport of curling. He had to go through grueling and intense chemotherapy. I'm happy to report that our guest has been cancer-free for the past 1.5 years. And in December, he'll be competing at the Canadian Tire Centre for a spot to represent Canada at the 2018 Winter Olympics in South Korea. Please join me in showing your respect and pride for Ottawa's very own Olympic hopeful, Craig Savelle. I'm going to make a quick procedural announcement. There are 3 pieces of paper on your table. Those are for questions. So what's going to happen is, and maybe I'll do this now, Ted and Jonathan and Jacob, I'll get you to come sit up here at the panel. If you have a question, you are welcome to write that question down on a green piece of paper. Put up the piece of paper in your hand. Jason will be Jason back there. We'll kind of collect the paper from you, and then it'll go to Chad Sakely. He's their tax expert there. He's going to triage the questions for any redundancy and then move them up to the head table. So at any point when you have a question, you can feel free to do that. Now you came here to hear from Ted and our expert panelists, but I also have a special treat for you. Chief Justice Ripp has agreed to give us some brief comments about what these changes mean and how a former judge of the Tax Court of Canada would look at these types of changes. Now I'm going to ask Chief Justice Ripp to come to the microphone. He'll be talking a bit about that, and then he'll also be introducing our speakers. Chief Justice Ripp.
Thank you very much. The only reason I'm here is to gain tone. You know what? People are going to get tired of hearing my voice, so can you introduce the speakers? So before I introduce this evening's speakers, you also asked me to make a couple of quick comments on the proposals of July team. I'm not going to speak anything specifically. What I'm going to say is just this. Whenever there are major amendments to the Income Tax Act, you can be sure that professional tax advisors will be applying their intellectual tax planning abilities to challenge whatever amendments costs clients or themselves more tax. Now this, as a judge, will lead to a heavier load of cases in the tax court, the federal court, and probably the Supreme Court of Canada. And when the courts finally decide what something means, or what something's finance thought meant, can be something way different from what finance contemplated. I've been around a long time, over 32 years in private as a judge, and about 10 11 years in practice, in private practice, and another 24 years with the Department of Justice tax litigation. And I remember tax reform in the early 70s. And I'll give you an example of how things got contorted between the finance and the courts. Remember, we have what's called a business. Now, Revenue Canada Finance thought a corporation owning a couple of apartment buildings, or a couple of units, or holding a few mortgages would not be an active business. But they never thought of an employee incorporating himself in those days. But the courts decided otherwise, and finance had to start restricting the meaning of the word active business by adding such terms as specified investment business, personal service corporations, etc. Even the term more than 5 employees, which they thought would mean 6 at least, did not mean 6 employees, it meant more than 5, which would be 5.5. So after 32 years on the bench, and hearing arguments, and looking at the act, and the courts are always fought for 3, 4, 5, 6, 7, sometimes 10 years behind with the statute, the current statute. So after 32 years on the bench, I cannot claim to even think on the tax plan. And when I was working in Montreal law firm the past year and a half, I saw the way tax planners work, and there's no way that I could be a tax planner. There were just too many changes in the legislation. If anything, I could be described possibly as a tax litigator if I could do litigation, which I probably can't, because I was a former judge of the court. And if I was a tax litigator, and acting as a tax litigator, when I read the proposed changes and see the words such as reasonable, I smile and shudder. This is going to make a lot of money for the lawyers, but can cause logjam in the court for several years until the courts can opine what is reasonable and what is reasonable. Depends on the facts of each particular case, so you may not get that much help. It will depend on particular circumstances. So this and the efforts that we make to challenge the legislation with creative planning will keep the courts busy. Don't hold your breath for speedy answers. In many situations, your opinions will have to be subject to potential court decisions. I cannot predict how long this will take. The small business decisions took over 5 years, if memory serves me. And now, I'd like to introduce the speakers. From my understanding, what's going to be happening, and Dean, you could correct me if I'm wrong, is that Mr. Cook is going to speak for himself, and then Mr. Milasek and Mr. Sharon will have a team. So basically, we have two against one situation. Which seems to be, according to the newspapers, that seems to be the situation in real life. Mr. Cook is a director of tax litigation division, tax policy branch at the Department of Finance. He's going to be speaking on objectives of the proposed changes in the view of finance. Now, he joined the federal government in 2002. He has had various positions with income tax rulings, directorate of CRA, and the Department of Justice, Department of Finance. He also worked with the national law firm. He has an MBA from Dalhousie and an LLB and LLM from Oxford Law School. He also has written Canadian tax research, a procedural guide, and principles of Canadian tax law, 3rd edition, which has been cited by the Supreme Court. Mr. Milasek is a CPA CA. He's a partner in Henry Warren Chartered Professional Accountants. He specializes in income tax, focusing on owner-managed businesses. He graduated with the highest honors from Carleton, and as soon as most people here have done, have completed the in-depth tax course. And the in-depth tax, just on a bit on the side, the in-depth tax course started off where it was, I guess, in the early 80s. There were some lawyers in the tax litigation section who would take the course. And I remember when John Howard, who would know, and I said, John, what do you do when they give examples? How do you have to look at the exam? He said, I don't do that. I said, well, what did they say when you don't do that? I said, I'm a lawyer. Accountants have to do that stuff. I don't have to do it. So that's the way lawyers work sometimes. Anyway, Mr. Lawson is also a board member of the Ontario Audit Real Estate Council. Mr. Shannon is a tax lawyer with Haswell Law. He specializes in working with accountants on tax planning and corporate transactions. He clerked at the Federal Court of Appeal. He worked in the tax litigation section of the Department of Justice. He has the master's degree from the University of Montreal and holds a études commerciales. He was a gold medalist in his graduating class with his law degree at the University. Gentlemen.
Actually, can you hear me? Someone left a BlackBerry on the podium. Thank you very much for the introduction. And I guess my only response is that I'd be delighted if it was actually just 2 online. But I did accept the invitation with a little bit of trepidation, knowing a lot of what's been going on in the media. And then as soon as I came, I thought, well, this is a good opportunity to hear, from professionals in a situation other than I usually do, and hopefully I'll be looking forward to learning from you in the context of the consultation. And then I heard the introductions of the head tables and the people in attendance, and by the time I went back to being trepidated. So with that, I guess in the spirit of it, so we're currently in a consultation that will close on October 2nd. In that, I genuinely am kind of interested to hopefully take away as much as I can to take back to our work. Given sort of, sorry. If you can hear me in the back, can someone wave?
That's a little better there.
Okay, sorry about that. Do I need to do the jokes again? Or? Anyways, so just for some of you that, so what because we were in sort of consultation mode, I'll try to provide clarity to the extent I can. I'll try to answer questions to the extent I can. Where I don't know the answer or I'm not in a position to be able to respond, I'll indicate that. But hopefully I'll be able to provide enough to make our evening here worthwhile. So what I'd like to do is spend the next probably a little less than 30 minutes and sort of go through from the Department of Finance perspective, sort of go through and kind of frame the policy issues that we're trying to tackle in the consultation paper, what the policy responses are from our perspective in kind of a general way, and I think that's where we'll end up with a fair bit of a discussion. And then I'll kind of mention a little bit of what we've been hearing so far in respect to the consultations. Okay. So what I'll do is proceed in sort of an orderly fashion first, and if you attended on Monday, you've seen the presentations before, so I'm just going to kind of do it the same way I did on Monday. So what we'll do is talk about income sprinkling and conversion of capital gains, conversion of dividends into capital gains. Those were two areas where draft legislation was released for a comment, and then we'll talk about the passive investment income, which was set out a couple of proposed approaches, and then requested ideas from stakeholders. So what do we mean by income sprinkling? Well, in a very general way, what we mean is tax planning arrangements that under which income that would otherwise be taxed in the hands of one individual, presumably a high income individual, are instead taxed as the income of a lower individual, lower income individual, typically a family member. So the effect of an income sprinkling arrangement is to try to take advantage of the tax attributes of the lower income person. This can be their marginal rate schedule, personal tax credits such as the basic personal amount, access to lifetime capital gains exemption, things like that. And when you start thinking about income sprinkling, if you sort of accept that frame, is that it depends on a few things. Because we're talking about trying to access different progressive rates, at least in part, then the more income the sprinkler has, or potentially has, the greater the benefit. The lower the income of the other person, the greater the benefit. The number of people that you can sprinkle with, and as I mentioned, the amount of income. There we go. So what I thought I'd do is just kind of walk through an example that was in the consultation paper. If you look on the left-hand side, you'll see a base scenario, and we'll call it a self-employed person. I guess I've started thinking of it as people who are earning income outside of corporate solution. So if a person has $220,000 of income in Ontario, and all of that is subject to personal income tax, assuming the numbers are right, they'd be taxed at approximately $79,000. Now, on the other hand, this is sort of based on materials we've seen of actual planning that does go on. If the person has a spouse and an adult child and can carry on the business activity through a corporation, they can sprinkle out the dividends or make the two other parties shareholders, and assuming the spouse and adult child don't have any other income, then they can effectively reduce the overall tax liability by a significant amount. Here it suggests that they would be overall all-in tax of about $54,000. So again, just noting, if there was another adult child, there would be another set of progressive rates to take advantage of. If there was more income, then that could be sprinkled out. If there was less income, if the person was making $100,000, then obviously there's less absolute benefit because they're not as high on the marginal rate scale. So, and this is a chart that's also in the consultation paper that I always find very telling. So this is payment of non-eligible dividends, receipt of non-eligible dividends by age. in Canada, and it's 2006, 2010, and 2014. And I guess from our perspective, what we find interesting is obviously if you look at the left-hand side, you'll see that there's virtually no non-eligible dividends received up to the age of 17, which, no surprise to this group, kind of coincides with the application of the existing tax on split income or kiddie tax found in 120.4. And then once we hit 18, where current TOSI no longer applies, you see quite a big spike that goes up to sort of around age 22. It goes back down, and then it takes sort of what you think of as a normal distribution. So what does that mean? Well, if you kind of frame it in sort of the discussion that we just had, you sort of go, well, people 18 to 22, a lot of them are in post-secondary education, which means that they're not raising, they aren't earning significant amounts of income, and as a result, there may be more benefit to income sprinkling to that cohort. And I guess, that's one reading of the data. And for those of you that have been, following sort of the debate in the media that's come out since the release of the paper, there are certainly people who have quite clearly indicated that, part of the reasons of having money in a private corporation and paying out dividends is to fund post-secondary education for the children. Now, just sort of moving on about that a bit. Well, what is it about private corporations? Well, private corporations, as I think you'll probably recognize, can facilitate income sprinkling arrangements. Because you've got private ownership of the business, you have greater control of how the ownership structure is allocated between different persons, and you have greater control over the distributions of the income earned by that entity. Now, in this particular context, you think, well, what's the tax policy concern associated with that? Well, it would allow individuals, and we say high income individuals here because potentially they're the ones that would presumably benefit the most, can control income and to whom it's paid. And that doesn't arise in other places where people don't control the income and who it's paid to. For example, an employee. In some respects, the ability to cycle income through a private corporation and do that kind of control represents an ability to sort of opt out of the progressivity of the tax system. And in terms of, I don't know if I've got a slide here, but certainly if you look at sort of certain indicators of corporate tax base versus personal income tax base, there's certainly been sort of a shift. So that's just kind of an overview of income sprinkling. And obviously, we've got existing rules in the Income Tax Act, which seem to address it or constrain to some greater extent income sprinkling. The first I'll just mention is just the basic rule in Section 67 of the Act, which provides the limit on deductibility in all respect of all expenses incurred in the course of earning income that they have to be reasonable, and that of course would include salaries paid to anyone, including family members. As well, we've got attribution rules that apply to certain gift arrangements, and they will depend, on the relationship of the recipient and also potentially the age of the recipient. And of course, we've got the tax on split income, which was introduced in 1999. And it imposes flat top rate taxation on minors under 18 who receive certain types of income, including private company dividends and other business amounts received via trust or partnership from a business or related person. So there are a number of rules already in the Act, and how do they work? Well, the attribution rules there's certainly in the adult context, when they apply to spouses, there's planning techniques that can be used to circumvent them. We've got limited rules in the Act that currently apply to other adults, including adult children. And with respect to the jurisprudence, I think a lot of this goes back to the 1998 Newman decision, where it's a classic dividend, what we call dividend sprinkling scheme from a lawyer's corporation to a spouse. And in that decision, the court essentially held that as long as the dividend is valid from a corporate law perspective, there was no benefit conferred by the other individual in a corporate action, and that there's no sort of test to sort of determine whether the dividend was earned or in any sense. Its shareholder effort is not relevant in the determination of the taxation of a dividend, which I think leads to a lot of what we're talking about here tonight as a matter of corporate law. Dividends are either they're legal or not, and there's kind of no further test in relation to the shareholder. As well, in the last 15 years, we've identified some structures that seek to circumvent the TOSI rules, some of which we've previously tried to put in place amendments to address, and a couple are included in this package as well. When I talked earlier about the kind of attributes that could be used, one of them is the lifetime capital gains exemption. If you can have, the requisite property held by a family member or perhaps a trust, and then distribute the property or the associated gains to those individuals, then there provides opportunities for multiplying the lifetime capital gains exemption. Same sort of policy concern arises. For example, in the trust, the trust may own the property throughout the entire period that the gain arises, but it may be only put in the hands of the beneficiary right at the end, or even by way of allocation of the gain upon disposition. Oops. Sorry. So what's the policy response? I tend to think of it in three ways. That currently TOSI applies to those under 18. TOSI would be expanded to potentially apply to adult family members as well, adult children and spouses. TOSI's kind of a bright line test. If you receive a dividend and you're under 17, from dividend from a private corporation, and TOSI will apply. You'll be subject to taxation. There's no sort of further test. We didn't feel that was appropriate in the context of people over 17 or more their own economic actors. And so what we've introduced is the concept of a connected individual. That is who kind of really are described as the sprinkler, someone who's involved with the business and would have a requisite level of control or influence over it. If a dividend is paid to the related person, then we would apply what we've called a reasonableness test. I think it's more articulated in the actual legislation as an amount that's in excess of what would have been paid by an arm's length party with respect to the labor contributions, the capital contributions, risks assumed by the person, and taking into account any prior remuneration amounts received by the individual. The idea is to try to outline factors which would show whether or not the individual has, in some sense, earned the amount paid out. Now, the consultation paper itself recognizes the challenges with respect to the proposed reasonableness test, and that's one of the areas where there's specific request for comments as to how it might be better targeted, and if there are ways, better ways to apply a test to deal with the kind of policy issue I've identified earlier, then obviously we're interested in hearing that. We do recognize some of the evidentiary challenges in place with respect to applying something like this. As well, the test is slightly different for those between 18 and 24. For those, it's a more stringent test that would require a more continuous, regular, and substantial involvement in the business, and then it provides a limit on the return of capital on capital contributions. With respect to LCGE, we've provided that no longer qualify for LCGE in respect of gains realized or accruing before the age of 18 years. That's kind of in line with sort of a bright line test, which currently applies for TOSI. Generally, LCGE will not be available in respect of gains accruing while properties held by a trust, except for certain trusts that sort of represent ownership by beneficiaries, such as certain employee share ownership plans. And as well, LCGE will not apply generally to the extent that the taxable capital gain is included in an individual's income subject to TOSI. So that's a very quick overview of what's being proposed. And just before I turn to conversion of dividends and capital gains, obviously there's been a fair bit of policy debate, even at a very fundamental level, as to whether or not this is the right approach. There are some who sort of agree with the approach we've taken, that there should be some connection to the income earning process for the individual. Others feel that share ownership represents its own return, and that should be very sufficient. And that the application of these rules would fail to take into account informal contributions by family members, particularly those by spouses. I guess one response to that is the way we tax other income fails to take into account the contributions of spouses in terms of earning income. Obviously, people have raised the potential compliance burden with respect to the reasonableness test that might be difficult to apply. As Chief Justice mentioned, the litigation may or probably will ensue at some level, and just the complexity of the rules themselves. Finally, people have raised potential impacts with respect to planning that occurs in succession and post-mortem context. Next, I was going to speak about the conversion of dividends into capital gains. And I guess it's a bit of a sidebar. I think most people, when they look at it, if they were going to put the proposed measures onto a continuum, they would see the conversion of dividends into capital gains, this kind of more traditional response to tax planning. They would see the income sprinkling measures as kind of being in the middle, and then a lot of people view the proposals discussed in the paper with respect to passive investment incomes as being very, very far-reaching. So obviously, I'll just kind of pick up some steam here with respect to the conversion of dividends into capital gains. Obviously, dividends are included in income; they're subject to dividend tax credit, and but the point is they're fully included in income. For most individuals receiving the same amount of cash, their tax result, the difference between and capital gain may be the difference between 43% and depending on whether you're converting $100,000 of dividends into capital gains, your return might be, this tax savings may be between, maybe 11,000 or 17,000. So how does the conversion of dividends into capital gains work? Well, if we didn't have a rule like section 84.1 of the Act, what a person who is a holder of shares in an operating company could do is just establish a holdco, and then they could sell some of the shares of the holdco and whatever the amount required is to the holdco, take back a promissory note, and essentially tax-free and a corporate dividend would be paid up from the from the opco to your new holdco, and then the holdco would just use those amounts to pay for the shares it purchased. So you would effectively take out the same amount of money at capital gains rates as opposed to as a dividend. What section 84.1 does is it says that if you sell shares of a corporation to another corporation related to you, that could be a corporation owned by you, owned by your spouse, or owned by your children, that the amount of that otherwise the capital gain will essentially be treated as a taxable dividend to the extent it exceeds your cost or buck. Now, I guess I don't know how important it is for the planning debate, but I would just note that section 84.1 does not apply in respect of a sale to another individual, on the theory that when you sell to another individual, well, the underlying surplus still is retained in the corporation, and if they want to take that money out, then presumably they're going to be getting a dividend, and the dividend will be subject to the appropriate tax at that time.